Please subscribe my channel. The trading floor of the New York Stock Exchange opens every morning at exactly 9:30 a.m. Eastern. Traders arrive early. They check screens. They sip coffee from paper cups. They watch the pre-market numbers tick upward or downward in small, predictable increments. On the morning of May 14th, 2026, the screens did not tick in small increments. They fell, not slowly, not gradually. In 6 hours, $2, 1 trillion in market value simply disappeared. The trigger came 72 hours earlier. President Donald Trump announced a sweeping 25% tariff on all steel and aluminum imports. Not targeted, not negotiated, across the board. Every trading partner, every alloy grade, every category. The statement was delivered via social media at 6:47 a.m. on May 11th. 17 words. Effective immediately, all steel and aluminum entering the United States will face a 25% tariff. No exceptions. Within 90 minutes, the European Union responded. Not with a statement, not with a diplomatic note, with action. The EU Commission activated pre-prepared countermeasures targeting $47 billion in American goods for bonds, motorcycles, and agricultural equipment is blue jeans. The precision suggested the list had been ready for months. The numbers tell the dependency story. The United States imports 26 million metric tons of steel annually. Canada supplies 38% of that total. Mexico supplies 11%. The European Union supplies 9%. Combined, these three partners account for 58% of American steel imports. American manufacturers depend on this steel for automotive production, construction, energy infrastructure, and defense contracting. There is no domestic substitute at current scale. There is no reserve inventory. The supply chain operates on 14-day cycles. Trump's team presented the tariff as a negotiating tool. First, they would impose maximum pressure. Second, trading partners would scramble to offer concessions. Third, better deals would emerge within weeks. Fourth, and most critically, American steel manufacturers would immediately expand production to fill the gap. The plan assumed partners would negotiate rather than retaliate. They retaliated. Canada announced matching tariffs on $12 billion in American goods within 4 hours. China, which had been watching quietly, added $84 billion in countermeasures targeting soybeans, pork, and natural gas. Japan, historically cautious in trade disputes, announced a formal review of all existing trade commitments with the United States. South Korea suspended talks on a joint semiconductor manufacturing facility in Arizona worth $3 billion. Australia, a military ally, issued a statement expressing deep disappointment and began consultations with alternative trading partners. Gene Holloway is a 34-year-old production supervisor at an automotive parts plant in Lansing, Michigan. He has worked in manufacturing for 11 years. He coaches his daughter's soccer team on weekends. He eats lunch at the same diner every Thursday. On the afternoon of May 11th, Gene received a memo from plant management. The memo stated that steel costs had increased by 28% overnight due to the new tariff. Production schedules were being reviewed. Layoffs were possible within 30 days. Gene read the memo twice. Then he called his wife. He told her, "They said this would help us. It's going to cost me my job." The market opened on May 14th, already down. The Dow Jones Industrial Average fell 847 points in the first hour. By 11 a.m., it had shed 1,523 points. The S&P 500 dropped 2%. The Nasdaq fell 4%. Manufacturing stocks led the decline. Caterpillar, which exports 60% of its production, fell 11% in a single session. Boeing, dependent on global supply chains, dropped 9%. Ford and General Motors each lost more than 8%. Technology stocks followed. Apple, which assembles products across 17 countries, fell 6%. The selling accelerated through the afternoon. By the closing bell, the total market capitalization of U.S. equities had contracted by $2. 1 trillion. Not over weeks. Not over days. In 6 hours. Retirement accounts shrank. Pension funds recorded losses. University endowments took write-downs. The velocity of the decline triggered automatic trading halts 3 times during the session. The damage radiated beyond equity markets. The U.S. dollar fell 3% against the euro, the largest single-day drop in 18 months. Treasury yields spiked as investors fled risk assets. Mortgage rates, which track Treasury yields, rose 4 percentage points overnight. Homebuyers across the country saw their borrowing costs increase by hundreds of dollars per month. Small manufacturers that had locked in steel orders at old prices suddenly faced contract defaults. Banks that had financed those contracts faced exposure. Credit markets tightened. Warren Buffett, speaking at an industry conference in Omaha the following day, offered a characteristically calm assessment. He noted that tariffs are not strategy. They are blunt instruments. Strategy requires understanding what your counterparty values, what they fear, and what they can afford to lose. Tariffs imposed without that understanding become announcements of vulnerability rather than demonstrations of strength. Markets, Buffett explained, price in the consequences faster than politicians can react to them. The $2.1 trillion loss was not punishment. It was repricing based on new information about leadership judgment. The political fracture followed predictably. Republican senators from manufacturing states faced constituent fury. Farmers in Iowa, already squeezed by Chinese countermeasures from previous trade wars, saw soybean futures collapse another 8%. Auto workers in Michigan received layoff notices. Steel executives, the intended beneficiaries, issued statements calling for immediate tariff suspension because their customers could no longer afford their product. Within 72 hours, 14 Republican House members publicly urged the White House to reverse course. Trump's response came on May 17th. A social media post at 11:34 p.m. He called the market reaction temporary. He blamed unnamed advisors for poor execution. He announced that tariffs would remain in place, but suggested exemptions might be granted on a case-by-case basis. The statement clarified nothing. Markets opened lower the next morning. The signature phrase emerged not from Trump, not from any politician, but from a senior bond trader quoted anonymously in the Financial Times. Asked what the episode revealed, the trader said, "You don't negotiate by burning your own factory down first." The line circulated immediately. It was translated into 22 languages within 48 hours. It appeared in editorials across Europe, Asia, and North America. It was projected onto the side of a building in Brussels. It became the headline of every major financial newspaper. Trump tried to impose strength through scale. He believed that announcing the largest tariff would force the fastest concessions. Instead, he demonstrated that scale without preparation is simply scale without preparation. The markets understood. The allies understood. The voters in Lansing, Michigan understood. The tariff remains in effect. The exemption process remains undefined. The $2.1 trillion is not returned. And the phrase, 6 words that captured the entire miscalculation, continues to circulate. You don't negotiate by burning your own factory down first. Please hit the bell icon and subscribe my channel for daily updates.